In this video, we are going to be looking at sources of federal tax revenue with a specific focus on income taxes. Now, income taxes can typically come from two sources: individual people and corporations. Benjamin Franklin once said, "In this world, nothing can be certain, except death and taxes." Indeed, taxes represent an important part of our lifestyle. They can even find their way into popular culture, as evidenced by that Bruno Mars B.O.B. song, "Baby, you're the whole package and you pay your taxes." So let's talk about taxes, specifically individual income taxes. In other words, is the government really taking that much of your money? To understand income taxes, we must first think about brackets. No, not those brackets. Actually, I'm referring to income brackets. The federal government will tax individuals based on their range of income and at different levels. For individual income taxes, there are 7 rates: 10%, 15%, 25%, 33%, 35%, and 39.6%. I know, very random bracket. In the United States, we also tax people into different categories: single, married filing jointly or qualifying widow/widower, married filing separately, head of household with dependents, and intertwined in illicit polyamorous relationship. Okay, just kidding about the last one. The IRS does not recognize these sort of relationships, for tax purposes, that is. The following table shows the tax rate associated for different tax brackets in April 2015. For the purpose of simplicity, I'm going to focus on single filers. So let's assume I had a friend named Elaine, and she made $100,000 in income. Looking at her 2015 tax bracket, see what range her income falls under. Does the government tax 28% of her income? Nope. That is false. In fact, this is one of the biggest misconceptions about the individual income tax. That if your income falls under a certain tax rate, it applies to all of your income. Nope. Instead, tax rates are applied on a graduated scale. Remember my general video on taxes? I explained how income taxes are progressive. That is, as one income increases, the government taxes more of it. But how does that work? Simple. Look at this chart. Don't understand it? That's okay. It's not exactly intuitive. The important thing to remember is that each of these income ranges represents specific tax brackets. Each tax bracket has a high range and a low range. Why don't we take a simple example? Let's take the case of a girl named Penny. Let's assume her income is $9,000. We can see from the chart that the tax rate on Penny's income is 10% because it falls into the first tax bracket under $9,225. Okay, let's assume Penny has a friend named Leonard. He makes $35,000. What rate is he taxed at? Well, the amount of his income that went up to $9,225 would be taxed at 10%. The remainder of Leonard's income, the one that falls into the second tax bracket, is taxed at 15%. Okay, hold on. What if things got more complicated? Let's take the case of Raj, who makes $75,000. How is he taxed? Well, the first part of his $75,000 income that falls into the first bracket is $9,225, which is 10%. The next portion of his income is the portion of the $75,000 that falls between the income in the second tax bracket, which is taxed at 15%. The remainder of his income that falls into the third bracket, that's the $75,000 minus the low range of the third bracket, this amount is taxed at 25%. So what does this mean in the broader scale of income tax brackets? Well, to better illustrate this, let's assume we had 7 people and each had incomes that fell into the respective individual income brackets. So, in this case, we have Penny, Leonard, Raj, Sheldon, Howard, Amy, and Bernadette. And for the purpose of simplicity, let's assume no one is married. In other words, they are all single filers. How are they taxed according to the individual income tax? Well, you can see that although all of them have different incomes, all of them have part of their income, the amount that is below $9,225, taxed at 10%. The next part of their income, the amount that is the range of the second tax bracket, is taxed at 15%. You can see here Penny is no longer taxed because her income does not extend beyond the first tax bracket. And the next part of their income that falls between the third tax bracket is taxed at 25%. The cycle continues until we reach the last income tax bracket at 39.6%, where only Bernadette is taxed. You can see that because Bernadette has an income of $500,000, Her income is divided across all tax brackets, and so she pays a different tax rate for each portion of her income that falls into each bracket. An important side note is that this does not include credits, exemptions, and deductions. More on that later. Now moving on to the corporate income tax is a tax on the income corporations make. Like the individual income tax, corporate income taxes follow a similar graduated scale. Different income brackets are taxed at different rates. When corporations are taxed, however, it comes out of their profits earned. Corporations must decide whether taxes are to be squeezed out of earnings for their employees, shareholders, or something both. It's a tough balancing act. You can see in this chart from the National Priorities Project that over the past 70 years, corporate income taxes make up a significantly smaller portion of federal revenue compared to the individual income tax. Now, the way that the federal government leverages taxes on companies is not without its share of controversy. Many experts contend that U.S. corporate taxes are among the highest in the world. Critics, however, point to the fact that many companies can take advantage of loopholes to severely reduce their tax liability. Looking into the merits of this debate are far beyond the scope of this video, but maybe someday, when I get a team of super competent researchers, I could look into it. Coming up, the rest of the video series on sources of revenue at the federal, state, and local level. Want more video updates? Or do you just want my social security number? Click the subscribe button.